Welcome back to Strongman Personal Finance, everybody. We got a fascinating video from Mr. Ben Felix here, the doctor, the wizard of personal finance. Fund manager, PLW Capital. And I'm going to react to this video because I saw some comments and discussion on this. Are bonds hurting your retirement? Now, traditionally, what do people tell you? As you get older, you should have bonds in your portfolio as a higher and higher percentage to, be an offset to the volatility of stocks. Bonds theoretically are inversely correlated to stocks. When stocks go down, bonds theoretically, according to past performance, are supposed to go up because people rush into bonds, right? They sell their stocks and they rush into bonds, and that bids up the prices of bonds as stocks crash. And basically, it's supposed to help you weather the storm. Well, in my personal opinion, as a 34-year-old man who's not going to retire for 30 years or more, I don't need bonds. Now, I want to hear Ben Felix's perspective on this, and then I'm going to tell you my underlying theory about what the purpose of bonds are. So let's go ahead and watch Mr. Benny Boy here and see what he has to say.
Stocks and bonds have low correlations at short horizons, suggesting a diversification benefit. At long horizons, domestic stocks and bonds have relatively high correlations. Similarly, while bonds are less volatile, they have much worse long-term downside risk in terms of purchasing power, and they don't tend to recover after crashes the same way that stocks do. I think the main insight from this research is not that stocks are safe for long-term investors, they're still very risky, but that bonds can be even riskier. Over long horizons, like 30 years, bonds become riskier than stocks, more correlated with stocks, and have worse downside risk than stocks.
Okay, that makes total sense. If I'm going to buy a treasury, a U.S. treasury right now, it's paying 5%. Well, that's going to roll over eventually, and then it's going to mature, and then I'm going to have to buy a new one, and rates will come down. And before you know it, I'll probably be holding a treasury that yields 3%. And if you think over a 30-year time horizon, what is more likely to give you higher returns? A total market index or a treasury that is given to you by the government, which, oh, by the way, is tax inefficient, okay? What do you think is going to give you a higher return? Of course, stocks most likely will, okay, because you're investing in companies that hopefully grow their earnings over time as the world becomes wealthier, et cetera, et cetera, et cetera. However, I think the fact that what Ben is saying here is, at least from how I see this, is that you shouldn't really have a need for bonds if you have a very long time horizon. This is my thought process 100%. But if you need money and you need it soon, you should 100% be either in short-term, very safe bonds, or you should have your money in an FDIC, if you're in the United States, insured bank account. Why do I say this? Well, let's say you're about to hit retirement, right? This is a Japanese stocks, bro. The Nikkei 225, however you freaking pronounce it, okay? Let's say you're about to enter retirement on May 22nd, 1991, okay? You went all in Japanese stocks because they went up a lot. And you said, you know what, I don't need bonds because Dave Ramsey, he told me that I don't need bonds. So I'm going to go 100% stocks. Well, look what happened in 1991, and this was after the bubble pop, so the stocks had already been going down pretty massively. You had years and years and years of flat and even negative returns. So theoretically, wouldn't you want some kind of cushion in there to guarantee that you can generate the income that you need in retirement? I would say yes, because stocks can go down or remain flat for a long time. And if you have a 100% stock portfolio and you're selling during a crash to fund your current needs, you're going to get your cheeks clapped. You're going to drain your portfolio so fast, it's not even funny. So as you get closer to retirement, yes, you're probably going to sacrifice some long-term gains. But if you need cash and you want to guarantee, as close as you possibly can, that you're going to get that cash, well, guess what, ladies and gentlemen? You're going to have to hold some bonds. So over 30, 40 years, no way. I don't think I need bonds personally. In the short term, if I needed money in like 2 or 3 years and I needed to guarantee I would have that money, yes, I would probably be holding some bonds. Now, Basically, my strategy. So here is the life cycle fund for the thrift savings plan. This is actually my largest holding. It's not even VT. I'm grifting you. I don't hold any VT. This is actually my largest holding. This is my government retirement plan for the federal government and the United States Army. And this fund is basically VT, but you can't invest in some countries that we don't like Russia, Zagorski. And I believe they hold some Chinese stocks, or Hong Kong stocks, but they also don't invest in China. They don't really disclose exactly what they're invested in. I couldn't find any information on it. But basically, think of this as VT minus some emerging markets that we don't like. Maybe possibly some Chinese stocks. I don't think Alibaba's in here, etc., JD, all that. And Russian stocks, stuff like that. This is basically VT, okay? It's the L2065 fund. I'm not saying you should invest in this. I'm just saying this is 100% of my portfolio that is inside my government plan. Now, the reason I hold this instead of VT is because I don't have access to VT in my government plan, but this is the closest approximation. So let's look at the holdings. G Fund, this is basically short-term treasuries, 0.38%. The F Fund, this is like a bond index, okay? It's not short-term treasury, so it's a little bit more sensitive to interest rate risk. The C Fund is 50.78%. What's the C Fund, you may ask, in the green right here? That's the S&P 500. What's the U.S. stocks, bro? What's the S Fund? That is the rest of the U.S. stock market. So basically, U.S. stocks, bro, are a pretty significant part of my federal retirement. But I only invest in China, apparently. And then we have the I Fund, which is international stocks. Like I said, excluding some countries that we don't like. The bond part of my portfolio is 1%. Okay, and if I could make that 0, I would. But this is the most aggressive allocation fund they have, and I don't want to actively manage or try to replicate market cap weights. It's just the time is not worth the potential loss of the 1% of bond holdings, basically. So I just buy the L fund. But this is basically my holdings, and even if this stays flat for 10 years, it doesn't matter because I don't need the money. I don't need the money anytime soon. I don't care. I'm going to I don't dollar cost average into this because I'm not in the government anymore. But I'm just going to hold this. Okay, this is my largest holding by far. But when I get older, you know what I'm going to probably do? I'm probably going to have maybe a couple years of expenses in something like this. And once again, this is not an investment recommendation. The iShares 0 to 3 monthly treasury bond ETF. Why would I put it in treasuries? Well, U.S. government, it's in my currency, and they mature in 0 to 3 months, okay? So as you can see, look at the fluctuations. Now, you may think these are massive fluctuations, right? Or actually not. Look at the numbers. Look at the graph. 100, 100.2, 100.4, 100.6. This thing barely fluctuates, okay? Even with interest rates going crazy over the last couple of years. And why is it fluctuating? Well, because that's when they pay out the interest payments to the holders. It drops by the amount of the interest payment. That's crazy, right? So you can see that there's really no volatility. So if I were to let's say there was a crazy stock market crash, right? Oh wow, this thing might drop. I don't even know if this thing would drop at all. I'm not saying it won't. I'm not going to guarantee anything. But for short-term federal government debt, this thing is not very volatile. Or you could just put it in a high-yield savings account or put it into CDs, FDIC insured. But just holding bonds, like any type of bond, that's the other risk. So the first risk is that you hold too many bonds too soon. I actually agree with that. I don't think you need bonds when you're freaking younger. When you get older and you need the money, you need to be in shorter term bonds. And the reason I say that is because the longer the duration of the bond, the longer the average bond takes to mature, the more sensitive it is to interest rate risk. So if rates go up, bond prices go down. Now imagine, you heard the conventional wisdom. Oh, I'm going to have a 60-40 Boglehead BND portfolio, and the rest is going to be VT. So I'm 60-40. And I'll just live off I could sell the bonds and blah, blah, and they'll be inversely correlated. Well, it actually turns out that they weren't inversely correlated. So remember when stunk started going down in 2021? Oh, guess what? The bond ETF also dropped almost 20%. Why is that? Because interest rates went up and bond prices go down when interest rates go up. So if you needed money, You could have lost 20% in a year. Oh yeah, you should put your short-term liquidity needs inside a total bond market ETF B and D because it's bonds and they're safe, right? Wrong. This is probably as safe as it gets, okay, besides FDIC insurance. Government, US federal government treasuries. That's probably as safe as it gets. Don't sue me, bro. But buying bonds, I mean, like, bonds just aren't the answer to keep you safe in a bear market. It makes no sense whatsoever. Interest rates and bond prices are inversely correlated. And like I said, the longer the duration, the more sensitive they are. Look at TLT here, okay? This is the 20-year plus treasury bonds. So we went from 154 all the way down to, what is that, 71? No, I can't even see what that is. Maybe in the low 80s or low 80s? This thing got freaking wrecked, okay? But it's bonds, bro. It's safe. So no, I don't think you need bonds in the short term. But if you need money immediately or very soon, you should probably consider either putting it in a savings account that's FDIC insured, or maybe holding it in some treasuries. You're not going to get crazy returns, and stonks could go up during the year that you're holding this, and you might have some opportunity cost. But it mitigates the risk of stonks going down and you having to sell stonks at a loss, because that happens. Does that make sense, ladies and gentlemen? Bonds are not the end-all be-all safety play, but they have a purpose. Cheers.